Welcome everyone to Monthly Market Matters here at Strong Valley. As a reminder, this is our shorter version podcast that we put out every single month, different than our long form podcast that we put out quarterly. I'd like to remind everyone to check all the resources that are still available all the time on our website, news and information that we put out on a regular basis. I'm Jason Rankin.
Chris Connor here.
And I'm Kyle Trippel. And I think just kind of what we've tried to do on these monthly market matters is just kind of update everybody on what's been going on in the markets and the economy in the last month, and then any kind of timely topics that have come up. So with that, I'll kind of just start things up with an update year to date, kind of through the first quarter of the year here for 2023. Off to a lot better start than what we recall for most of last year. So we've had a turnaround in the equity markets across the board. The S&P is up about a little over 5% for the year, about 1.5% or so for the month of March. The NASDAQ's been on a tear, which is kind of the index that dragged the most last year. So it's nice to see some positive growth there for that. And it's up a little over 18% for the year and about 5% for the month of March. And then kind of the bond index that we kind of like to look at is the ag. And as we've talked about a number of times in our previous podcasts and our roundtables, the bond index was something that was really a drag on everything last year. And so we're starting to see some positive results in the bond market this year, with it up about 2.25% for the year and almost 2% for the month of March. So it's nice to see those returns as well as the yield still standing there for us. So lastly, one of the things that's come up quite a bit this year in light of interest rates and fear is the gold topic and conversation that seems to come up more and more when fear is more relevant. And so just to give everybody an update on the gold as well, it's up about 7.5% for the year. And a lot of that has transpired in the last month, really, since the issues of the Silicon Valley Bank sparked some fears in people, and it's up almost 6.5–7% for the month of March alone. So great start to the year so far. I think a lot of that was the first half of the year through January and February. Some inflation numbers came in a little higher in February that kind of caused it to sell off. And then we had the news a couple weeks back with Silicon Valley Bank that really triggered fear and panic in the markets and kind of gave up a lot of those returns. And that fear the last couple of weeks since then has really kind of quieted back down again. And we've seen kind of the market spike back up to those numbers that we were just talking about here previously. So Jason, I think you had some things you wanted to talk about.
Yeah, I mean, we can dive into the banks a little bit. That's something that we've all been dealing with over the last few weeks. And I know our clients have been paying attention to this as well. It would be hard not to. And so we can all kind of offer some information here as to what happened. And, I heard a good analogy describing what happened with the banks, as far as it wasn't so much, if we use Silicon Valley Bank being the largest one of the recent failures, it wasn't so much that all these people were trying to run out of a burning building. This is the analogy that I heard. It wasn't this building that was burning down and everyone was trying to run out and get their money out. It was almost like you had a building that was fine, and you had these large investors start to have some concerns. And so one person pulled their money out, and then someone sees someone else pull their money out. So they start thinking, well, gosh, if there is going to be a run, I better get my money out. And then all of a sudden you start to see this run where they had ended up, customers of Silicon Valley Bank had pulled out, I think, a quarter of the entire bank's deposits in one day. I think it was like $42, $46 billion that they tried to pull out on a Thursday.
I want to say it was $42 billion in 10 hours.
Yeah. And so the analogy was that it wasn't a burning building that everyone was running out of. The building was fine, but everyone just started running, and then someone knocked the candle over. And so the run itself is what created this issue. And so what caused the bank to fail, and what caused most of these banks that you've heard about to fail in this instance, it was that back here a couple of years ago, when interest rates were incredibly low, historic lows, and the Silicon Valley Bank was receiving so many deposits that normally what a bank does is you give them money and they go out and loan it to somebody else. And they were receiving more deposits than they had people to loan it to. And so when a bank gets that much money and they need to hold it safely, they will often go and buy treasuries. Now, in hindsight, they look back at it and they should have been buying very short maturity T-bills. So that way it was just revolving around, but instead they were trying to get more money, more interest, and they were locking these bonds up on average about a decade. And so when interest rates went up over the last couple of years, the bonds that they bought now on the secondary market, if they ever had to sell these, looked really ugly, because no one wants those old bonds paying low rates. Everyone wants the new higher yielding bond. So when the customers started to run on the bank and they had to go sell these bonds at the market, they were selling them at losses. And you keep dominoing that over, and all of a sudden it just kind of folds in on
Up to
itself.
20% in some cases too. So it was big losses.
Big losses. And so that's what occurred in many of these banks. And so I would fathom a guess that not every bank had the same issues or has the same issues that Silicon Valley did. They just got a little over their skis by locking all these customer deposits up in such long dated treasuries. And by the FDIC coming in and kind of doing a backstop, and I think they basically just kind of backstopped. It seemed like they backstopped just about everybody, even though they're saying they're doing it on a case by case basis. But that really seemed to calm the markets.
Well,
And so
specific to that case too, you have to consider it's a very small region that they service, right? So pretty focused in terms of the types of companies and individuals that they service. And some of those people are fairly sophisticated and were also not just pulling money just to pull money, but they were also locking in higher rates, because banks, the name of the game is pay the depositors as little as possible, loan the money out for as much as possible, highest rates possible. And that's how banks are slated to make money. And when you have, large deposits on hand, if you're a company at the bank, then, you have to do what's best for you too. And which means, going out and putting it into other short-term instruments that, don't have the same risk, but are giving you a lot more return right now because of the Federal Reserve raising interest rates. So
I agree.
It's not even a question of, hey, we don't want to be at the bank, but why aren't we earning, north of 4% on our deposits like we can in this 30-day Treasury bill? And so I think there was a lot of money that was moving, for that purpose too, because this is last 15 or so years, this is the highest short-term interest rates we've seen. And so CFOs and individuals, they have to do what's right for them too. And getting 1/20th of what they could get in other type of instruments helps them make the decision to move it out of a bank deposit too.
Yep.
Right.
So.
That's why we saw billions of dollars flooding into the Treasury market for two reasons. One was the fear of the banks. They wanted to have a backstop and a guarantee by the government. But like you said, too, they're also just at this point, it was a time to reevaluate interest and yield on your money.
Mm-hmm.
It's the highest rate since, I think, 2007. And so definitely something to watch. Another thing that I was going to touch on briefly, part of what has caused this issue with the banks is the dramatic speed in rates and how fast rates have gone up in such a short amount of time. But now that's beginning to flip. And so I've got a chart here I'm going to bring up on talking about the Federal Reserve's expectations of interest rates. Now, in full transparency, this is what the market currently believes. The Federal Reserve will never tell us exactly what they're going to do with interest rates. This is basically what the bond market is betting on, or banking on what they think the government will do, or maybe even forced to do, depending upon the economic cycle that we're in. So what you're looking at here, the current Fed funds rate is in the high fours, and the expectation is that interest rates may go up one more time in May by about 1/4 point. But then the market thinks that the Federal Reserve may begin cutting almost immediately after that, heading into summer. And that may be driven by multiple factors. If inflation is caught, if the economy is slowing down, if unemployment goes up, if we're in a recession, there's a lot of factors that could drive them to cut rates, or all the above. And so the bond market thinks that Jerome Powell is going to be cutting this summer. And then you can see that they're going to be pretty swiftly cutting this, to where if this chart holds true, by late 24, we could be all the way back down to about 3%, almost cutting in half from where we're at now. And so if that's true, it's something to be mindful of. A lot of folks are pouring into these money markets because obviously they're paying nice rates at this moment in time, but it's something to be mindful of, that rate that we're getting on those money market funds could very well be temporary. I mean, they're still going to be a lot higher than they were 2 years ago. But I don't think money markets are going to be paying 5%.
Well, not for very long. That's
Not for
for
long.
sure. I'm with you on that.
And that's in line with what we've been saying, even on our quarterly roundtables, that we kind of think in that midsummer, there's going to be kind of that flattening or that pausing of the raises from the Fed, and then potential for those cuts to start later in the year. Now, whether that's sooner now, summer months, or third, fourth quarter, I guess a lot of that obviously is data dependent, right? And the information that's coming out with inflation numbers and even employment numbers and job growth. So, in wages. So we'll see what those numbers come out.
I think the employment numbers are probably the biggest ones.
Right.
We start getting large scale layoffs and companies not hiring anymore. They'll definitely go to the pause button if they don't go to easing right away.
Yep.
I agree.
Well, one of the other things too, I mean, I think we've kind of hit a lot on the last couple months and quarters on inflation and Fed and rates. And so it's important still to talk about it because it's still relevant. But something that's kind of new for us this year was the Secure Act 2.0. And that was something that kind of came into effect at the end of last year, that now as we're planning for retirement plans and contributions and even the required distributions, there's some new rules and laws that kind of went into place this year, and will even be changing the next 2 or 3 years as they fully implement the Secure Act, Secure 2.0 Act. So I think Chris was some of those points in the, I mean, it's a large bill, a lot of different minute things and bigger things in there. Is there a couple things that really jumped out to you in that I think would be beneficial for clients to hear or know?
Yeah, like we're talking about before we started. Probably pick out a couple things. I mean, this is a north of a 350-page bill.
Yeah.
That they passed back in December, but a lot of these will not directly affect most of our clients. But I wanted to pick out a couple things that I think will and are interesting. And Jason, we were talking about this, you and I as well. Probably start with increased RMD age. Are you guys up to speed on exactly where that is and where it's been? Or rather where it's going eventually to 75. Had
right 75 in a decade, right?
Yeah. So it's been many years, and most of our clients still have 70 and a half in their mind as far as when they have to start taking withdrawals out of tax deferred accounts. And so, yeah, it's moving. It's already at 72, and eventually will be indexed out to age 75, depending on when you're born. So for folks born after, I think it's December 31st of 1958. So if your birthday lands after December 31st of 1958, you're going to be a 75-year-old required minimum distribution candidate. Most of our folks that are, and by the way, this doesn't apply to anybody that is already in required minimum distributions. So if you're 73, you just missed it. You have to pull money out. You can't wait for the 75 number. But it is a very specific, person by person calculation. But the age moving out to 75 is interesting for some of our folks that are not in that phase yet. But what is it, Jason, for folks that are supposed to start this year? Is it 73?
Yeah. So what it was is if you turn 72 before the end of 2022, then that's the year that you're starting your RMDs at 72. Mm-hmm. If you're turning 73 anytime between 2023 and 2030, then the RMD age is 73. And then that's where they start ticking it up from 73 to 74 to 75. And so essentially, if it's you turn 74 between 2030 and 2034, that's your birth. That'll be the RMD year. And then after that, it goes up to that 75 number you're talking about. So yeah, very complicated.
So
a lot of
long
brackets,
answer is
currently it's
confusing.
Currently, if you're not 72,
if you're in your low
RMD,
70s, call us.
Yeah, the new RMD is 73 for this year. So.
But also too, as all of our clients that are of that age will know, we keep track of these required minimum distributions. Right. It's not your job to keep track of these. So we always monitor these. We watch these dates, and we let you know when you have to pull money out if you have not already. But the date's a moving target. And that's based upon life expectancy over time increasing. So they're giving us a little room there on when we have to withdraw. But I mean, this is totally off topic, but I'm fully anticipating sometime in the next 5 years. You would assume that if they keep moving these age bands, as far as on this side of the coin, you think they'd be pushing the age bands like on Social Security and other things like that. It's been 62 since it was created in the early 30s.
Yep.
So you would think as people live longer, I think that's something similar that they're protesting, in France. But I imagine this country at some point in time will push that Social Security retirement age as people are living longer, and they may not allow us to take it as early as 62. Maybe they'll push it to 62 and a half or 63 or something like that. But that would definitely not surprise me.
It's going to take a lot of courage from one of these bodies of Congress to even.
Well, after seeing reflects, how people act in other parts of the world on this, it's not going to go over well. But we'll see.
Yeah, no,
one of the areas too that I noticed that were kind of intriguing is the increased contribution limits. So, I mean, over the last few years, we seem to kind of see that bump each year, both in the base deferral amount that you're allowed, as well as the catch-up provision. And that's gone into effect for both retirement plans, 401ks, your 403bs, as well as your individual accounts, your IRA accounts. So one of the things they did add in this year, obviously we got that bump to $22,500 for just normal deferral for 401ks, and the additional $7,500 catch up, making a total contribution of $30,000 for, the max amount for people that are over 50. But one of the things that they did implement that's new, that's kind of starting in a couple of years, is that if you're between the age of 60 and 63, they're going to allow you to make even more of a catch-up contribution beyond that normal, that whatever's in place. So the one caveat, that will have to be a Roth contribution, but that's something that they're trying to encourage more people to put more money away for retirement and take some of that ownership in retirement on yourself. And so that's another feature that's put in place this year that going forward for the retirement plans.
Yeah, so, and just to be clear on that, they're going to allow you to put more money in, but it has to be a Roth contribution, which means you have to pay tax on the way in. You won't have to pay tax on that particular contribution or the growth on that contribution on the way out, but it does not give you a tax benefit in that window for the extra catch-up contributions between 60 and 63, right?
Right. Well, and along those lines too, since we're talking Roth portion of that was one of the other neat features that was new this year coming up too, is normally the employer, if they're doing any form of a matching contribution to the plan, it always had to go in traditional, essentially pre-tax. One of the features now is they have what's called the Roth matching contribution option. So now your employer, if they're doing a 3% match, you have the option to select that match going in post-tax into the Roth 401k, which is something that was never allowed prior to. That's a new feature.
Yeah, and so again, the employer is not going to pay the tax.
No,
right?
The employee.
So it gives you the option as the employee, or it will give you the option. I haven't talked to any plan administrators that are ready to take that on, or payroll processors that are ready to take that on yet, because it'll be complicated. But they're giving folks the option to receive the match in Roth form by paying the tax on that as it goes in.
And that's a good point too, Chris. That's something that's now allowable in the act, but not something that's required or that may be eligible in your plan. So it's still up to the plan provider to implement that into the plan and whether or not it's allowed. And like you said, I haven't heard of any that are doing it yet either. So
yeah, I want to say Roth 401k was introduced in 2003, and I don't recall a single plan that we provide service to that really had anybody implement that for 5-6 years. It was just it was a long. First of all, you have to educate people on how that works, but second, you have to have administrators that are willing to do the record keeping on something like that, and it can be a lot on their software developers, and again, from an education standpoint, figuring out how it's going to work and make sure it stays legal. So that's an interesting one too. Did you want to touch on getting matching contributions? This will be confusing a little bit, but for some of our younger folks or children of some of our clients, being able to get matching contributions while you are making payments on your student loan.
Yeah.
So just to say that again, if you have somebody who doesn't maybe have enough money and is not making enough money to really make contributions to a 401k, company, provides a match for that 401k, but because you're not participating and you're just making strokes on your student loan, you're missing out on that maybe for years on end. So what the Secure Act 2.0 allows companies to do is to treat the student loan payments, even though those student loan payments are being made back to, let's say the federal government to pay back those student loans, use those student loans and act as if those are contributions to the 401k and be able to provide for that employee the matching contribution that would go along with that. So that's probably one super interesting. We talk about cost of college and higher education all the time, and how expensive it is. But one of the repercussions is you sometimes have folks coming out with large student loans, and that may put them behind 10 plus years in trying to make contributions to a 401k. And so they're going to miss out on all those company contributions and matching contributions all those years. And this allows employers that want to put this in place, allows them to do the right thing for folks and make those matching contributions as if those student loan payments were being made to the 401k.
And the key point on that, Chris, too, is, as you mentioned, it's the participant or the employer, the individual, still making the payment to the actual loan. They're still paying their loan. It's not going into the retirement plan, into the 401k. But what the option is, the employer then has the ability to match that. So, for example, if the employee is paying $500 to their student loan, the employer has a match in place. They're able to match that $500, but in the 401k, the employer is not making that contribution to your student loan debt. It's just going into essentially your 401k account for retirement purposes.
I think that's a pretty interesting one, because we hear from people that are a little bit later in the stage. I finally got my student loans paid off. Now I can start contributing in a big way to the 401k. And they may have missed 10 or 15 years of company contributions because they just weren't able to participate at all. So I think I would anticipate, a lot of employers putting something like that in as a perk, because everybody's trying to retain good people. There's, there are plenty of folks out there that you maybe don't necessarily want with your company, but you're forced to hire them because you need people. But it's hard to hang on to the really good ones, and this might be one way that you can help retain the good folks.
Yeah.
So,
well, I know that we always try to keep these within 15, 20 minutes. So kind of in an interest of time, is there any of those other topics in there that jump? Like, if we want to talk about Secure 2.0 Act, we could do it for an hour with all the different features of this law and get into the weeds of areas that most of our clients will never be affected by it, even our business owners. So is there anything else in there that really jumped out that was either interesting or you think that would apply to a large number of our clients or people?
This is one that Jason and I spent a little bit of time on, and that is 529 rollovers into Roth IRAs. Oftentimes we'll have clients that are done funding education for their kids, let's say, and they've been saving into these plans for years and years, and there's still money left over at the end. And it's sort of what do we do if we have too much money in the plan? And one of the new features in the act allows for rollover. Again, it's very rule ridden, but you can now roll up to a lifetime limit of $35,000. You can roll money out of a 529 plan and into a Roth IRA. So essentially shifting from an education savings vehicle off to a retirement funding vehicle, which is pretty neat and something that was never allowed to be done before. So again, you're subject to some limits, some annual limits.
It's a normal IRA contribution limit. So whatever, in this case, if it's $6,500 a year, that's how much you can do that year from the 529 to the Roth conversion. And then obviously with the lifetime maximum, as you mentioned, the 35,000. And then I think the other thing was the 529 had to be in place for 15 years. So there's a holding period. So people don't just overfund them and turn around and shift it into a Roth and get away from it. So there's reasons for that too. But I think that is something that's intriguing because his clients may have saved more than they needed or didn't end up going to college for the kid or grandkid. And now this money's there. And the option was to essentially pay that 10% penalty on the distribution to use for other purposes. Or in this case, now there's an opportunity for them to roll it over, portions of it over to a Roth IRA that, down the road are tax-free distributions for that child.
Yep. And you're subject to income limits on it also, income requirements and limits, I believe, as well. So just like anything, like I said, it's over 350 pages. There's a lot of material in there, and so if anybody wants to talk details on it, that's what we're here for.
And I'll throw one last piece in there on that too, without getting into the details. But for business owners, especially some of the smaller business owners with less than 50 employees, there's a lot of new features that are coming out as far as potential tax credits towards the starting and the implementation of the plan or setup of the plan. So if retirement plans aren't something that you've offered to employees but are starting to consider it, reach out, because there's new things that have come into place that might make some of the upfront cost essentially go away for you or reduce that expense for you. So just talk to us. So there's a lot of interesting things that are more geared towards or specific to the business owners that are looking to establish a plan as well, not just participants in the plan. So,
yep, sounds good. All right, let's wrap it up, guys.
All right. Well, thank you all for tuning in. As Jason mentioned, all these videos, will be on our website, and we have other information on there for our podcast, just timely updates that we do. You can even reach out and schedule request meetings to talk about any things. And then obviously clients, you have our contact information. If any of this has triggered any thoughts or questions on your end, please reach out. That's why we do these. And that's why we're available for you as well. So thank you all for tuning in, and hope you have a great day.
See you guys later.
Take care.